The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether or not your decision is appropriate for you. Property Investing Matters is brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hello and welcome to Property Investing Matters, and another great week with a fabulous new guest to talk about all that's happening in property right now. Well, it's certainly an interesting time, and so it was time to bring out some big guns and get you some of the best information from Australia's top experts, which of course this show always brings to you, and tonight is no exception. You'll notice a slight format change, a slightly shorter program with more discussion with our experts and less viewer questions, but you can still send any to me if you have them, and we will still answer any which come up for any of our experts. And so to our guest, Dr. Andrew Wilson from My Housing Market. You'll recall Andrew was one of my valued guests on Sky News during the Your Money, Your Call days, and tonight he joins me to share his fabulous expertise with you. Dr. Wilson holds a PhD and Masters by Research in Housing Market Economics, together with graduate qualifications in econometrics and construction economics. His experience spans senior property and construction economist and research positions within industry, academia and government. Let's welcome Andrew to the show tonight. And Andrew, great to have you back.
Well, it's great to be here, Margaret, and we certainly, as you suggested, have uncertain times and interesting times in our housing markets, but I guess that's fairly typical of what we experience, and it all tends to be a little bit of deja vu, I think, Margaret, to some degree, doesn't it? Rates up, rates down, It's a bit of the same.
If you've been around long enough, I think you see it all happen, and you can see that there are definitely cycles, even if we can't measure what the length of any of those cycles are going to be. Look, let's start tonight with 2022. I'd like to sort of get a good handle around just what's happening now. Could you go through the capitals for us and give us your outlook on what you're seeing right now?
Well, we've certainly had an interrupted cycle, haven't we, Margaret? Really, we go back 5 years, but the real interruption has been of course, the COVID lockdowns, and we did have our markets starting to recover in the back half of 2019. And of course, that was just after the previous general election. And we had come through a period of significant uncertainty over the 18 months prior to that 2019 election. And it's a little bit of the same now. We certainly have the fear factor rising in housing markets generally, and we can expect that, negative sentiment and lack of confidence to be a key driver of what happens in terms of activity over the next perhaps 12 months. But we, of course, then had COVID just as our markets were recovering through the back end of 2019. And, of course, lower interest rates helped that recovery. But COVID came along and we've had those interruptions really until the end of last year, particularly with lockdowns. But again, there was a lot of negativity in terms of the outlook for the housing market through lockdowns. We can remember some of those really quite ridiculous predictions in terms of not just the economy, but house prices as well. But we've seen a good old-fashioned boom once we moved through those interruptions from lockdowns, particularly in Melbourne and Sydney. But we have come to the end of that cycle, predictably now, that interrupted cycle of the last 2 years. And affordability barriers have certainly impacted Melbourne and Sydney because they were the clear early leaders in that boom time period. And other markets, although still growing, and I'm talking about Adelaide, Perth and Brisbane particularly, certainly their rate of growth is declining. And there's no secret to why this has occurred. We've had very strong prices growth, as I said, Melbourne and Sydney, but affordability barriers have acted to reduce buyer capacity. We're fortunate in this country that we have a very rigid banking system, which creates these levels, these barriers upon which we can't go above in our lending desires. So even though we'd like to get a couple of $100,000 more to purchase a particular property, if we can't afford it, that is, if we don't have the income, or the banks won't give us a lower interest rate, then we just can't get the loan. And this is what's been happening, and typically happens in periods of strong prices growth, where we were catching up through those interrupted periods, that finally those affordability ceilings start to push activity down. And of course, that means an easing of prices growth. So we've seen that this year in Melbourne and Sydney, Margaret. We saw it starting to ease at the end of last year. And now, of course, prices are flattening in those two capitals. Strong prices growth still in Adelaide and Brisbane, and Perth is reviving after a long period of subdued activity. But it is all about affordability, Margaret, that strong prices growth eventually acts to moderate buyer activity and capacity. And of course, along comes the bogey to housing markets, and that is higher interest rates. And of course, we've had 2 consecutive months of interest rate increases, with a third in the gun. And that will act to, again, reduce affordability, but more importantly, it will have an impact on confidence. So fairly predictable outcomes, Margaret, in a very unpredictable environment, COVID environment. But nonetheless, we do have the predictability of higher rates and unfortunately lower confidence.
Andrew, I'm going to ask you a question that really is about your opinion or your gut feeling, and it might even be one that you can't really answer tonight. But when we did head into COVID and we had lockdowns and we had job losses, or at least people being stood down, albeit for many of them they were getting the job keeper payments, we did all expect that the housing market would be really badly impacted by that, because people wouldn't want to be buying during times of uncertainty. Have you got any gut feeling toward why that didn't happen and why we still saw the boom continue?
Well, there was no secret to the fact that COVID really represented an interruption rather than a significant pause or in terms of supply and demand to our housing markets. Now, it was always going to be confidence in the early days, but it wasn't as though the appetite for property had diminished in any way, significant way. All it meant was that we didn't have the capacity to go out and transact property because we were in lockdown. And it's no surprise that the markets that did experience price declines through those interrupted periods were, well, particularly Melbourne, that had the most severe lockdowns, and it experienced the most significant price declines. But the Melbourne market, once lockdowns were behind it, bounced back very strongly. The Sydney market really kept on keeping on. It certainly went down for a short period. But once those restrictions were lifted, buyers were back in town and sellers were happy to get back into the market. And that's because our economy, of course, rebounded quite strongly with all the freebies that were given. But I think that the misunderstanding was that this was, something significantly, impacting the underlying drivers of our housing markets, whereas it was just really a distraction, a distraction that we didn't know how would it end. But certainly every time, and once we did start to move through those lockdown situations, confidence did rise. And it was just a matter of the markets that were interrupted catching up, Margaret, and that's what we've been doing till we get to the point where we've caught up.
Yeah, look, that's a really good summary, and I'm really glad that you've told us that, because I think a lot of people have had that question for a while. Now, we also saw, obviously, during this time, and it doesn't often happen this way, at least in my experience. I've been in the property industry for a long time now, as you know, getting on for 30 years now. And during that time, typically we will see capital cities will be doing well and the regions not so well. And then the reverse can often happen. When capital cities are languishing and doing really badly, we'll often see some big regional centres come through strongly and deliver some really fabulous growth. This time, and clearly as a result of the fact that regions came into focus with people thinking about more of the work from home thing, we saw the regions also perform strongly. We really saw property the country over, albeit Brisbane, Perth and Adelaide coming through a bit later. The country over saw this boom, or this flow-on boom, happen, and it's the first time I've ever seen that happen. Where are the regions at now that I think people are realising that they're not going to be working from home forever after all, that maybe the tree change they thought about hasn't turned out as well as they'd like? Where are you seeing the regions right now, at least the major ones?
Well, look, Margaret, there was obviously a sense that people were escaping the lockdown environment. There was a lot of predictions that regional centres would be the beneficiaries of this, that we'd see booming markets. And of course, there was some, significant shift into the regions. The region that was particularly enhanced through lockdown was southeast Queensland. It's still, there was a mass exodus out of Melbourne and Sydney into southeast Queensland, which wasn't suffering the same sort of lockdown environment that Melbourne and Sydney were. And other regions obviously benefit, but I do think it's been overstated to a large degree, the longer term significance of, regional exodus out of Melbourne and Sydney. Yes, we can work remotely more positively now, but it always, the issue with, the larger regional centres is a lack of infrastructure. And that's what does keep the drift, at some stage, once we get back to normality, it eases that drift into regional centres. It may accelerate some of the retirement plans and the green change and sea change plans, but I don't think that's significant enough to really move beyond the cycle in a sense. However, as I said, southeast Queensland has been a significant beneficiary of record migration, interstate migration, as a result of those lockdowns, and we have seen very strong prices growth in Brisbane, contributed to by that migration shift, but also Gold Coast units and houses have been a beneficiary and remain a very strong market as that shift continues. But I think that's the big issue, that even though we've had a shorter term drive into some of the larger regions, I'm not sure that'll be sustained to the point where they become boom markets because they don't have the infrastructure or the economies to support those high levels of demand that some have been predicting. But nonetheless, regional markets have moved upwards as the capital city markets have moved upwards as well, and they've provided good returns as the capital cities have provided over the past 3 or 4 years.
Andrew, do you think it's fair to say then that those regional markets that are almost no longer regional, like,
yes,
your Mornington Peninsula, Geelong,
yes.
Central Coast, Wollongong, maybe Ipswich, around Brisbane, Sunshine Coast, that they'll keep the demand because they're still commutable if need be?
Yeah, absolutely, Margaret. And I think they're part of the greater capital city regions. Every one of those markets that you mentioned is really if not now, certainly heading quickly to be part of Greater Sydney, Greater Melbourne, Greater Brisbane. And that's because, the affordability pushes people further outwards. As a result of higher demand, you get higher levels of infrastructure. We're seeing, really Northern Gold Coast is just about joined Brisbane now. I think Geelong is part of Melbourne, really. I mean, it's just a 20-minute drive between Geelong and Melbourne City. I think the Central Coast has always been regarded as part of Sydney, and Wollongong as well is, again, just a 30-minute commute out of the southern suburbs. So it is a part of the demand cycle, but it is also about those areas being able to provide the not just the proximity to the capital, but also building their own infrastructure levels to be able to support higher population.
And I think that's the key, really. Once we start to see significant infrastructure, livability, lifestyle factors, then those areas no longer need really a connection to a capital city, even though there is undoubtedly one, because they can often provide everything someone needs without them ever. I mean, I live on the Central Coast, as you know. I very rarely end up in Sydney unless it's to an airport. So I get everything I need here. Let's turn now to interest rates. I'm always keen to hear your views on interest rates, because at this stage, if we look at them, we can't see the ceiling. Have you got a ceiling in your sights?
Well, no, Margaret. And, the Reserve Bank really did a flip-flop on this one, didn't they? And, for a long time, they were telling us that the next move in rates, they predicted or they saw that rates would rise early in 2024. And then, of course, we're now in the complete reverse, and rates aren't just rising, they're galloping ahead. And the question is not whether we get rate rises, is whether they're going to be small, medium or large. And they tend to be more large. And I think the Reserve Bank tends to be, refocusing itself on a monthly basis in terms of the level of interest rate increases. And this is, of course, because of the uncertainty in regard to inflation. I'm not so sure that, the traditional policy of raising interest rates is going to have a significant effect on inflation without actually causing an economic downturn. And this, unfortunately, is usually the end game when we get into this cycle. Australia is fortunate, and we are fortunate to have a very strong economy going into a higher interest rate cycle, which is typically what we do experience. But we're already, perhaps because we went earlier into the higher interest rate position than other similar economies, we're in a stronger position to, hopefully avoid a downturn. But it's going to be a very fine balancing act, Margaret. And, I think there's a lot of wishing and hoping and praying going on in central banks everywhere to try to get this one right. But, history tells us that it is very difficult to create a soft landing. I think we've got an outlook for interest rate increases over the next year. But the problem is that a lot of what's driving inflation is really not going to be sensitive to higher interest rates. And I'm talking about fuel costs. International fuel costs, of course, are still rising and still at very high levels. There's nothing higher interest rates will do to control that. We're just trying to stop inflation spreading itself through the community, and we're seeing signs of that by reducing demand. But all this is eminently predictable, Margaret, because we all got paid forward during COVID, and that's fair enough because we didn't know what was going to happen. But now, unfortunately, we're going to have to pay it all back, and that's what we're doing through higher interest rates.
Yeah, good way to see it. Look, rents have also been very hot, so
Yeah.
if you're a renter, you don't get any reprieve there. Do you see that continuing for the remainder of 2022?
Well, absolutely, Margaret. And, this has been, formulating itself in our housing markets for a number of years. We tightened credit controls for investors back in 2015 and then through to 2018. We made it almost impossible for an investor to get a loan because all of a sudden they became persona non grata. They were to blame for all housing market ills, and banks were instructed to reduce lending. Now we're paying the price with an emerging social crisis, and I don't use that word unadvisedly because we do. And the people who are owner occupiers tend to be more in a more comfortable financial position, but those that are in the rental market generally don't have the same capacity to be able to absorb particularly higher inflation. And that along now comes surging rents. I've had rents rising, Margaret, in Sydney by $10 a week every week for the last month. Sydney is now approaching $700 a week as a median rent for a house. And I've seen, from a low base, unit rents in Sydney rise by 20% over the last 12 months. And that's because, we are opening borders, we're getting students and migrants, of course, but also that the choices that people have in Sydney for houses are so limited and the prices are so high that they have to now consider having a unit, more affordable unit, even if they have to consider having have a family. So this is a pretty picture. And we can't really resolve it. And it's not just Sydney, it's everywhere. And we can't resolve it because it's the plain problem is we just don't have enough houses, Margaret. And we haven't, as well as not having enough investors by those restrictive financial policies, we've also restricted developers, particularly unit developers. And that's where the new black is and will be units, and again, it's very difficult for developers to get their projects up, but demand is so far ahead of supply, and it's not something you can just sort of add water to and it all fixes itself. And of course,
Andrew,
we have.
Yeah, I'm no economist, but looking ahead for me, if the interest rates are going up and we then see investors getting a little bit frightened to get into the market because they're worried that they're not going to manage their investments that well, they'll stop investing, which is just going to add to the rental shortage.
But to my mind, Margaret, this is another difference from the interest rate increasing cycle that we've commenced, and that's our housing markets are in a positive position with demand over supply. We've got rents going through the roof, and we've just opened our borders up again. We're predicted to have 200,000 international migrants re-enter Australia this year, and we will continue to have those numbers going forward. Australia is a high migration country. It's a policy that all parties adhere to. And then we've got a surge in international students coming in as well, looking for accommodation. And that's why we're even the markets, the sub-markets that did have a level of supply over demand, and that was the CBD in Melbourne unit market, and also inner city suburbs in Sydney, vacancy rates are plunging in those particular markets because of, as I said, choices people are making because they're being priced out of houses and suburban markets, but also we're getting the demand coming through from students and migrants, and that's certainly going to continue. So as I said, this is just a problem of not enough properties, and I think if you're an investor, where else are you going to get those returns in such a certain environment, Margaret? Now yields are rising now because rents are rising, faster than prices, and we've got a weaker stock market, and other asset classes are weakening as they do under a higher interest rate environment. But rents are continuing to rise at record levels. And there's no easing, quite sadly, for tenants. But these are solid returns for investors.
And of course, there's the added thing that in some markets, like Sydney and Melbourne, and some of the larger holiday markets, yes, owners of units are taking them out of the long-term rental pool and short-term letting them as Airbnbs. Yes. Guilty of having done that and making 3 times on a unit now, yes, that I used to make long-term making 3 times that much on a short-term letting basis. So that then, unfortunately, the people who want to go and live in that area, I every day get emails from people saying you wouldn't consider renting your unit out long-term to me because I can't find a unit.
Well, this is the Airbnb factor was significant through lockdown, Margaret, because a lot of those holiday accommodation, business accommodation models turned their properties into permanents because, of course, borders were closed, not just local borders, but international borders. So their supply of tenants was limited. So we had, particularly in those unit markets, inner city unit markets in Sydney and Melbourne, we had a high supply of vacancies there with those extra Airbnb properties coming into the permanent market. But now it's reversed, as you said. Now, Airbnb is, it's very difficult to get an Airbnb property in any of the capital cities now, Margaret. Borders are open, and those, Airbnb rents have really gone up quite strongly. Now we've got borders open again. People are traveling again. Airlines are very busy. It's not just holiday makers, it's business travel is back up and running again. And this just means fewer properties for the permanents. And this is a very difficult situation.
Absolutely. Look, Andrew, I've got a lot more that I want to talk to you about, but we do have to take a very short break. There's plenty more to come for the viewers when Property Investing Matters returns. Hi there, I'm Margaret Lomas. If you're a seasoned property investor, you probably already own a few properties, so you're likely busier than ever before. Why not let Destiny help you in the same way that we've already helped many investors with large portfolios by using Property Match to add properties which fit into that portfolio and address common issues that bigger portfolios can bring. Head to mypropertymatch.com.au to find out more, or give us a call on 1300 My Destiny. Welcome back to Property Investing Matters, free and on demand on My Property TV. I'm Margaret Lomas, and joining me is Dr. Andrew Wilson from My Housing Market, and we're discussing Andrew's forecast for 2022 and 2023 nationwide. Andrew, before we went to the break, we were talking about the unit markets of Sydney and Melbourne and how their rents are going up. What about in our smaller capitals like Adelaide, Brisbane and Perth, where units haven't typically been a thing, certainly inner city units? Are we seeing any changes in those markets?
Well, demand certainly is robust and strong in the smaller capitals, Margaret. Brisbane, of course, it doesn't seem so long ago that we were being flooded with headlines such as, Brisbane oversupply, why would you be dumb enough to buy a unit in Brisbane? It's going to take years to, absorb all that we've built there. Well, now, the Brisbane Council is desperately trying to find sites for apartment development, and prices and rents are rising very strongly in Brisbane apartments. Adelaide too is developing quite a solid unit market. Rents and prices are rising there. Perth is a little smaller in terms of its scale, but again, I think the big picture here is that units are the future, because it is not just about affordability; it's about access to infrastructure. And also, I guess people are looking for, perhaps, if I could say, more of a modern lifestyle in terms of, their structural choices as well. And, even though, we've had the issues with work from home, and, we can move out to the sort of the outer suburbs and work remotely as a response to COVID, we are starting to see that drift back into, or that rediscovery, perhaps we could say, to inner city or inner suburban apartment. And I think the big problem is, Margaret, and it's all capitals here, we're just not building enough. And it's going to create, again, higher rents and higher prices once we get through this correction cycle at the moment for prices. But certainly the upside to that always will be rents increasing. And I think, the governments tend to ignore the supply side of the equation because it's too hard. And just keep thinking they can, manipulate demand in some way. And of course, all that means is higher prices and higher rents. And, we've seen that exploding now because of policy positions of the last few years. And now we have this terrible situation where, people can't afford or find rental accommodation.
Yeah, look, speaking of Adelaide, obviously suddenly it's come through and it's doing very, very well. And while the figures are showing around about a 26% growth, in reality there are many areas that are doing considerably more than that. I know that from, I have a significant property holding in Adelaide. Thankfully it's doing something. And I've seen some of my properties go from last year being worth maybe in the mid threes to now being able to sell them for over $500,000. That's how quickly those particular properties have moved in certain areas. Do you think Adelaide will go backward and come off, or will it just maintain this new peak that it's attained?
Well, Adelaide was always, I guess, a boom waiting to happen, wasn't it, Margaret? The thing that held the Adelaide market back for some years was, of course, the local economy. It did have a number of hits to the local economy through the late noughties and into the tens, and that really did hold the market back. But Adelaide has recovered. Its economy is now travelling as strong as any of the other capital city markets. It's had a significant reduction in its unemployment, as all capitals have over the last year. And of course, the big advantage for Adelaide is affordability. I mean, that's what keeps pushing prices up in Adelaide, is the fact that its median house price is still half that of Sydney's and well below that of Melbourne. So you certainly get more bang for your buck in Adelaide. And of course, wages aren't that different in Adelaide compared to the eastern capitals. So you can actually afford to pay more. And when, I guess that those interrupted environments, people start to, I guess, bring forward some of their buying and selling decisions. But I think there's no doubt that Adelaide, along with Brisbane, and Adelaide is the strongest performing capital city market at the moment. It is certainly not growing as strongly as it did through what were extraordinary levels at the end of last year, but it's still growing at above a 10% annualised rate at the moment. But again, with this strong prices growth, we will see an easing in prices growth because of affordability barriers starting to impact the market. But it is the top performer, Margaret. No surprise, really, to some degree, given its significant affordability advantages and also its much improved economic performance.
Andrew, we have a more complex economy in Perth because of the mining influences. We have seen, I guess, affordability drivers in the Perth market as well.
Yes.
Although one of the things that Perth does still have is an awful lot of land and a lot of land releases happening all the time. Do you see any more for Perth? It's had a reasonably good run for Perth, and not the best run, of course, Australia-wide.
Yes.
Do you see more happening there?
Well, look, it looks like it's coming back, Margaret. We sort of had a bit of a false dawn around 12 months ago with Perth, and then it flattened a little bit. I think a lot of that was actually the measurement process, because Perth had a remarkable building boom last year as a result of the home builder policy from the previous government. Perth was building only second to Melbourne in terms of new houses. I think a lot of that price energy from a lower cohort worked its way into the overall price measures. But Perth is picking up now. It's recorded consistent quarters above 2% in terms of growth. But, the remarkable thing about Perth is, if we go back to prior to the GFC, which is a while back now, but Perth actually had a higher median house price than Sydney back in 2000 and 2007-8. But, of course, it really was impacted by the end of the mining boom, the end of the fly-in, fly-outs, and it is the most affordable capital city now, which is, a tremendous change from where it was. So, I mean, logic tells you that it will catch up. I don't think it'll get back to where it was, because markets over time adjust to the financial conditions of the local market. But certainly it's on the upside now, and it should be, given it is the strongest economy in the country, and it is the most affordable housing market, Margaret. So I would expect to see continued growth in the Perth housing market. Nice steady growth around about that 2% mark. But of course, it will be affected, as all markets will be affected, by the scare campaign that's currently underway.
Now, I am going to ask you about Darwin, because Darwin always confuses me. What's going on there?
Well, Darwin tends to be a volatile market, Margaret, and we shouldn't be surprised at that, because it is a very small market. It has a significant, of course, unit profile. It has a lot of building. I used to go to Darwin all the time for work and, doing real estate presentations. But I'm always a big fan of the Darwin market, but it too suffered from the end of the mining boom. A number of projects that were, expected to support the Darwin economy over a lengthy period of time didn't come to fruition. Of course, it did have a lot of new supply in the apartment market, but the Darwin market does bounce back. And the other point about Darwin, when you measure prices in Darwin, Margaret, you have to take account of the seasonal factors, the wet and the dry up there, which can tend to mask a price movement. You need to have a longer term view when you're measuring what's happening in Darwin. But I think that, Darwin, just once it reestablishes itself over the longer term in terms of its economic performance, I think there's good value in Darwin. But it certainly is a volatile market, but there are reasons for that, Margaret. And prices have been steady but not spectacular during what's been a very strong period in most of the other capitals.
Now, Hobart's had a dream run, obviously, unexpected dream run. Unexpected for me. I always told people never to buy in Hobart, because, let's face it, you don't get a lot of inward migration from retirees. It's not very warm, so unless you love the cold, you don't go there. Apart from affordability, what else was behind that dream run, and where is it sitting now?
I think there was a growth in confidence in Hobart and Launceston post the change to their political environment, Margaret. Got to remember that Tasmania had a number of years where it has a unique political system, where it had a conference government of a number of parties, and I think that tended to perhaps at some level restrict its growth, particularly infrastructure growth and confidence. But I think once that there was more certainty in the political environment, I think that helped the Hobart market rebound, which it did very strongly 3 or 4 years ago after being subdued for a while. Hobart tends to be a little contrarian, and I don't mean that disrespectfully, but it does tend to rise when others are falling and fall when others are rising. Now, that's probably not a trend that's particularly to Tasmanian housing markets, but I think it's just the nature of the drivers. But it's had a very solid run, been a little bit of a quiet achiever, I think, Margaret, over the last over the COVID period. And is continuing to grow, but just some signs now, like with other capital cities, that the growth rates are starting to ease. And perhaps the Hobart market won't take as much notice of the doom and gloom predictions that sadly, in the short term, will affect our housing markets on the mainland.
So for an investor who still wants to go ahead and invest now and isn't getting spooked by the interest rate rises, where do you think would be an area that they should be focusing on now, for at least for stability?
Well, I think you look for strong rental returns and higher yields, Margaret. Isn't that investing 101? You've got to understand that the whole point of being scared by interest rates, and that's fair enough, because higher interest rates make your mortgage more expensive. But of course, an investor has the capacity to offset those increased mortgage costs by having higher rents. Now, it's a business. That's what you do. If you have higher demand, that means that you can improve your profitability or offset factors that are reducing your profitability. And these are unique circumstances for investors in terms of high demand for investment properties. But as I said, or was going to say, that every interest rate increase, Margaret, as history tells us, is potentially an interest rate cut down the track somewhere. And the point here is that, and we experienced that in 2019, that the Reserve Bank, in my opinion, held interest rates far too high for far too long in 2016 to 2019. And finally, they decided to cut it because they had to, and it released all that pent-up demand and that energy that had been, that had been building up in those periods of the fear campaign, like we have now. But so, as I'm saying, is that the Reserve Bank will, I think, unfortunately, have to find itself in a position where it will need to stimulate the economy, because it's reduced demand to the point where unemployment is higher, and it will require lower interest rates. So that's the whole point of the cycle, Margaret. We're back in the roller coaster. The roller coaster is on its way up now, but as we know, one day it will start to fall. Now, if you're generating a consistent income with high occupancy rates, then you wait for your capital growth to pick up going down the track. And as I said, this is a very sticky wicket for the central bank, for the Reserve Bank. And it is obviously committed to get inflation down, even though it's a lot of what's causing inflation is beyond its control. So I'd say that to investors, that this is almost, with higher interest rates, money in the bank for capital growth.
Absolutely. That's great news to hear that. Finally, where in the country at the moment can we get the best rental yields relative to price?
Well, Brisbane, Adelaide and Perth, no surprise, Margaret, have the highest rental yields at the moment. They're yielding nearly 6% on a unit. And even though we're seeing some moderation in prices growth, prices are still growing in those three capitals. And which means that even though yields are sort of flattening at around that 6% mark, it's good news, because your total returns with yields and capital growth are still pushing up towards 15% per year, Margaret. So that's good news in a tough economy for with inflation rising at the highest level since the early 80s and set to go higher. The value of the dollar is falling, but to be able to get those consistent returns and also with all those tax advantages, I think really it's in a weakening and uncertain global environment. I think that certainly a property, as usual, appeals to those as a safe haven going forward, Margaret, and the numbers completely support that position.
Well, that's good to hear. That's all I have for you this week. Don't forget that iTunes subscription to keep up with the show every week. It's free and you'll never miss an episode. Andrew, thank you so much. I can't thank you enough for your insights.
Great to be here. Good luck.
Lovely to have you on. We'll make sure that we catch up every 6 months or so, get that roundup, get some common sense, make us all feel a whole lot better, which of course you've done tonight. If you've got any questions for Andrew, get them to me and I will forward them on. And I'm sure that Andrew would be only too happy to give some feedback. myhousingmarket.com.au for Andrew. Now, if you have a question or you want to contact me between shows, you can email me at pam@mypropertytv.com.au or reach out via social media. They're all there on the screen for you to see, and you can send me a DM to any of those channels as well if you'd like. If you'd like some guidance on where you should be buying property, a Fab Service Property Match is for you. Allow us to do all the work for you in hunting down that next hotspot. Go to our website and give us a call. Have a great week, and I will see you back here in 2 weeks' time when we'll be talking to Damien Collins about WA. Don't miss that show.
Property Investing Matters was brought to you by Destiny, empowering investors to achieve success through property investment for more than 24 years.
Hi there, I'm Margaret Lomas. Buying an investment property isn't about finding something that looks good and thinking that it will make a good buy. It takes years of experience and countless hours of research to identify an area that'll perform well and a property which is right for your circumstances. Let me introduce Property Match. It's a revolutionary new system which uses machine learning and our 25 years of experience to find your next investment property. Head to our website mypropertymatch.com.au or give us a call at Destiny to find out more.